All right. Well, thank you, everyone. Thank you very much for coming. We're just going to give it a minute or two. Rob, you there?
I am here, I think.
All right. Yes, Rob is here. Everyone can hear. Good, good, good. Well, yeah, thank you, everyone, for coming. As everyone knows, it's going to be an exciting 2017, and we're excited, and Rob's excited. I just got back from the Independent Mortgage Bankers Conference yesterday, and a lot of activity, a lot of mixed activity too, a lot of positives, a lot of negatives. But ultimately, everyone's looking forward to the spring. The goal with this is just Rob, as everyone knows, is the leading industry expert in housing and finance and news and the secondary market, and really has a great thumb on the pulse. And just to sort of, to give all of our customers a chance to ask Rob questions and get Rob's insight on what he thinks is going to happen in 2017, and sort of just bridge on that. At the conference, you heard a lot of the things. I'm sure everyone's been watching the news about the new administration and rate hikes and all those types of things. And the goal is just to kind of provide some clarity as well as some thoughts about it. As I travel around the country, meet with our customers all over, and then Rob speaks at all these places, you kind of hear a lot of things. And after, kind of reading what's going on, I realized we needed to bring in the best in the world, and we got them with Rob. So, Rob, with that said...
Brian, yeah, enough. No mas.
There you go, exactly. With that said, we're going to go ahead and turn it over to Rob and just kind of start kicking things off. Rob, do you have anything you want to kind of preface this with? I mean, let me ask you this. What are you hearing? What are you hearing right now? What is coming across your desk every day?
That's a good question. The general mood of the industry, I would say, is a little bit mixed, but it's pretty good. Last year we started off and everybody was in the doldrums, and then rates went down, and suddenly everybody got excited. And 2016 turned out to be a great year for many companies and a great year for many people in the industry, whether you're a loan officer or a CEO. So 2016 was very good. Then you have to ask yourself, gee, if I had a mediocre 2016 or my company isn't doing so well, even after a year like 2016 where rates were in the threes for much of the year, what is it about 2017 that's going to turn the tide, either individually or for the company? But the mood is, as I said, a little bit mixed. I would say that loan officers and employees are pretty excited. The question is why. Rates are still decent. The big problem that I'm hearing out there in terms of the general industry, if there is anything, is that, gee, we're gonna see a big pickup in purchases. Then the question is, where are the purchases going to come from? Because when I talk to realtors around the nation, listings aren't exactly setting the world on fire. There's definitely a lack of listings out there, so you can say, well, purchases are really going to kick in here. The question is, what are people going to be buying? And what I'm seeing is a fair amount of baby boomers who are perfectly happy in the houses that they're in. They have kids in the school district, or their kids, even the kids who have grown, they're staying put, and so the number of listings is a problem for realtors. So you've got that going on. But overall, the mood with the loan officers is good. The mood, I think, in the proverbial C-suite, with the CEOs and so forth, is a little more of a concern. They're tentatively worried about market share. They're worried about margins. They're worried about interest rates, perhaps. But overall, I would say the mood is decent. Well, you just came back from the conference in Southern California. What was were people dancing in the hallways there?
No, so what I see, and it's not necessarily from the conference, is you got two scenarios. You got the guys who are block and tackle originators who have big margins, who are purchase heavy, who are your traditional distributed retail, who I don't want to say are unorganized because that would be a poor indication. They are organized, but they are not as engineered as sort of these call centers. Some of our customers have, you walk in their office and it's like, they got 20 or 30 engineers on staff that are business process engineers, that are, analytics engineers, that have, all sort of, doctorates and PhDs and these types of things, and they're all going after, and they're operating traditionally on razor-thin margins because they've been handling the refis traditionally. Well, for the last 3 years, all they've been doing is gearing up towards the idea that the baby boomers, not the baby boomers, the millennials, are going to start wanting to do purchases online. I mean, that's been kind of the thing, even though they've never truly tested it. And even though, 70 to 80% or 65 to 70% of the business has been refis, especially last year. And so what I see is sort of this like mixed bowl of, the distributed retail guys are really concerned with their margins and making sure that they are in a position to compete with these really high-tech engineer business process flow, Google X board member type people, and then you have the business process Google X engineer type thing guys worried to death of how am I going to compete with the block and tackle guys who really know how to go out there and pound the pavement and sell. And then you have some that are in good positions that have a little bit of both. I even know some block and tackle guys that are out looking at buying call centers, and I even know some call centers that are out looking to buy the block and tackle. But I think and from what I've seen and what I've heard, is sort of as things are starting to change, or the perception is they're going to change, nobody really knows if this kind of online purchase millennial, type business is actually going to work. Because if you look at the top purchase shops, they're all mostly distributed retail. And, they're 70, 80% retail. I mean, 70, 80% purchase, 90% purchase, and then you got kind of the refi. And there are kind of a lot of questions, especially at the C level, of like, all right, what's the next step? Because if I got to operate on the call center margins, I can't do that with my current operation. But at the same time, we've been able to outbeat the call centers on the purchase. But if this goes full tech, we don't have the technology to compete with them, nor do we have the engineers. So what's going to really happen? And then knowing that 80% of the purchases or the relationships are referred by the realtors, puts the call center people in a very vulnerable position as well, because they're not used to nurturing these leads for 6 months. They are, turn and burn, in 10 days, or, the refi takes 30 days or something like that. It's not a long, extended time. So that's kind of what I'm seeing. But let's get into the questions, and then hopefully, we can. So what do you think about the recent rate hike? I mean, we covered this a little bit. We all expected it. Now that it's here, what are your thoughts on it? Do you think it's going to happen more? Do you think, they're going to level it out? I mean, there was even some talks about this just being a test, and they may go down again, depending on how the market responds. There was some tests about
I haven't.
There's some.
Oh, I was going to say I haven't heard the test part of it. I think the U.S. economy is too big or too important to kind of say, oh, let's try that. The rate hike happened mid-December, just like it did last December. Last December, they raised rates, overnight rates, and then the 30-year mortgage rates just, proceeded to be very low for the first, 3 quarters of 2016. So it's happened, and loan officers and lenders are dealing with it. When I talk to loan officers or CEOs, the rate discussion doesn't come up that often. They're too busy focusing on their business plans, too busy trying to grab market share from someone else, too busy recruiting to really think about rates. Getting back to the economy here, the Fed tends to react rather than set the tone for the economy. And excuse me, I have to sneeze here. Excuse me.
Bless you.
Thank you.
Okay.
That being said, you know, the Federal Open Market Committee has more transparency than ever before. The Fed presidents of the various regions are always out speaking, except when there's a blackout period leading up to an FOMC meeting. So at this point, they have certainly mentioned that more increases are ahead. The market at this point kind of assumes there's going to be another overnight Fed rate hike in mid-June. Okay, so that's 4 or 5 months away.
Yeah.
There are 3 meetings between now and then. There's one here next week. There's one in mid-March, and then early May. So we have a lot of time before the assumed next increase is going to happen. I've heard, 2 increases, 3 increases. That's pretty much baked into the market. And I think what's going to happen is the market is going to decide to shift its focus to something else besides. It's almost as if people don't have anything else to talk about besides the Fed and Janet Yellen and possibly what Donald Trump's relationship is going to be with the Fed. But the rate hike happened. Companies are dealing with it. Most people think that rates are going to go higher. I'm not entirely convinced of that. I think there are arguments that rates could go lower, in that, it's easy for Donald Trump to talk about some of the things, some of the infrastructure improvements, for example, he wants to make with his administration. But he's got Congress to deal with. It's not like he can sign an executive order and spend $1 trillion. He's been signing a lot of executive orders here in the last week. They've been garnering a lot of press. But when you're dealing with the U.S. economy, you can't really snap your fingers and spend, X amount on infrastructure. The thinking is that with unemployment already so low, where are the potential workers going to come from in order to build bridges, repave highways and so forth? Will wages increase in order to attract those workers? The answer is probably yes. Will the economy really be motivated to move higher and stimulate growth? Probably. There's a lot of momentum that way. But remember, the United States is only one country in the world, and we do have a great economy compared to many other countries. But if something happens overseas, in the Ukraine or with China, in Africa or Europe, then easily we could see yet again another flight to quality and other companies or other countries buying our bonds, pushing prices up and rates lower. So I'm not convinced rates are going to go dramatically higher, at least initially. We could be here for a while. And so what I'm hearing out there among loan officers is that there's a decent percentage of buyers out there or potential refinance candidates still who have heard about rates going up this year and saying, oh my gosh, well then I better refinance. Well, I better buy now ahead of rates going up. And so with some companies, I'm actually seeing a little bit of a boost in volume because of that thinking. So, and then lastly, when you talk about interest rates and when you talk to people who have been in this industry for any length of time, especially really old guys and gals, they'll tell some story about, I remember when rates went from 19 down to 18 and a half, and then you ask them how business was. Oh, business was great. We were doing a lot of volume. And you think, holy smokes, what? Obviously, 30-year mortgage rates weren't at 19%. There are, a lot of ARM programs out there and so forth, but there's the argument to be made that even if rates go higher, it's because the economy is doing well, and if the economy is doing well, more people will qualify. If more people will qualify, then business could be just fine for originators who are able to take advantage of it. So I'm not doom and gloom in the least regarding the interest rate environment, and I think we'll just deal with it as it comes along.
Yeah, and there's something to be said for like what you're talking about, income growth has been so stagnant that, things just like interest rates come in cycles, income growth, comes in cycles. And, there has been a lot from what I have seen talks about, the economy really taking off. I haven't seen the legs of that, at least in my, in my conversations or my travels of that, 100%. But that is somewhat of a, if income grows and the economy really takes off, there is a whole separate set of issues regarding housing and stuff that will become a much bigger problem, because you're right, there is not a lot of inventory out there on the market, especially, there's whole areas where, the houses are on the market for 4 or 5 days total, and they're not building as much as they should. Especially in some of your city markets, there is a huge shortage of housing. So let's go about, so the Trump administration, and don't quote me on this 100%, but they've indicated that they plan to roll back about 75% of the regulations within the financial markets. It includes the repeal of Dodd-Frank, and some of that has already been in discussions, with the SAFE Act, right? Like previously to the Trump administrations. What are your thoughts on this? Do you think it's positive or negative to deregulate the mortgage lending industry in a big way? Or just, what are your general thoughts on that?
So you don't want me to quote you on that? You don't want me to hold you to that?
Let's say maybe 76% or 73%. So, just right. I've read mixed reviews on the percentage, but just the general consensus is a massive rollback.
Yeah. So let's talk about some of the things that have happened here recently, namely the MIP, mortgage insurance premium with FHA. So the question that Washington has to deal with is trying to figure out a consensus. Washington may be coming to the conclusion that tight credit in the housing market is really a problem, and it might be time to roll back some of the more restrictive regulatory policies and begin to encourage home ownership. Home ownership is down, low 60s, mid 60s. I forget what the last Census Bureau statistic was. But the housing market has proved to be very resilient. People say, oh, there's a problem with the housing market. Well, you know what? The housing market itself, if you look at the prices, they're back to record highs, especially in places like San Francisco, Austin, Texas, some of these other areas. Your prices have done very, very well. And the more liberal part of Congress, so we say, they want to see more lending to lower credit, lower income borrowers, and maybe we'll come to the realization that bashing the banks isn't the best way to go about doing that. On the Republican side of the aisle, the conservatives are becoming a little more accepting of government's role in lending. You've got some social engineering going on in the housing market, and the Republicans would love to see housing starts rebound back to some kind of normal level. Then you get into the discussion of the mortgage interest rate deduction, which could become a problem if they really start reforming taxes. But in terms of the overall regulatory environment out there, if it's really true that, and I don't remember that 75% statistic, but if that's true, I personally think it's a mistake. Most of the people in this business are professionals who freely admit that lending was too unregulated 10 or 15 years ago, because many of the regulations that have been rolled out here recently have helped borrowers. They also, on the capital market side, they help give investors insurance that the loans are what they believe they are. If you're an investor and you're buying a 3-bedroom, 2-bath house and you think it's worth $300,000 and the loan amount is $250,000, you want to be assured that all that is accurate. So are we going to do away with the regulations or the compliance issues that ensure that kind of information? Probably not. If you view the regulatory environment as a pendulum, yes, we're starting to swing back a little bit, but we shouldn't swing back to where we were 10 or 15 years ago. I personally don't think that will do anyone any good. You need a strong capital markets. You need investors who believe in the product that they're buying. And so you've got that going on. In terms of the political situation, you know, as I mentioned earlier, Democrats have always been interested in really being involved and having the government involved in lending. Republicans much less so. The GOP retreat kicked off last night in Philadelphia, and the Republican leadership outlined its agenda for the next couple hundred days. You know, you talk about tax reform being a high priority, not so much infrastructure spending, which is interesting, getting back to the rate discussion. So tax reform, that'd be great. You know, I think I know the barest minimum of individuals who do their own taxes anymore. I mean, the tax code and the complications and so forth, it's just a nightmare out there. It's been a nightmare for decades. So if they're able to do something like that, wouldn't that be nice? But it's also important for listeners to remember there's a distinction between the House and the Senate. Ryan is going to have a much easier pathway toward passing legislation through the House than McConnell will in the Senate. And so when you talk about tax reform, you know, he may be able to do that much more easily than they will in the Senate. But the thing about what's going on with the politics of the whole situation is that you know, you've got this push and pull. You've got Elizabeth Warren, who tends to represent the you know, the left, and you've got others. You have Hensarling, for example, who tends to represent the right. And when you talk about Donald Trump and rolling back regulations, I think first of all, they're not going to do away with Dodd-Frank. They may amend Dodd-Frank. They may change the leadership of the CFPB. That's almost guaranteed, to make it a board like other government agencies versus having all the power with one individual. But the CFPB isn't going to go away. Dodd-Frank is not going to go away. And I think that anyone who thinks that that is a panacea or is going to really boost my business, you know, I think they need to take a look at the bigger picture and figure out some of those regulations, like I said earlier, have helped borrowers. They've helped the secondary market. And when you look at, once again, 2016, the industry had a great year despite LOCOMP, despite TRID, despite the regulatory environment. And so, you know, things aren't so bad that we need to reform the entire system. I think we need to take what works, keep using it, and tweak what doesn't work, and then move forward.
Yeah, and well, from what I've talked to, and then we were at some parties in D.C. for the inauguration last week, and there was a handful of people from HUD there, and from the new administration. And their spirit is not necessarily the deregulation part, but more about the enforcement part, where the goal is to make lenders feel comfortable making loans, and that you're not going to have a situation where there'll be a ton of regulatory enforcement for kind of hyper-technical violations. They think, from what I've talked with them, they think the biggest problem is not necessarily the regulations, but the way the regulations are go about it being enforced, and the sort of like abusive nature of some of the previous administration regarding fines and regarding sort of that have sort of you know, disheartened a lot of lenders in making more loans to people that are on the fence. And I think from what I've seen, it's going to be more in that spirit, not necessarily like a complete rollback. Right. It's going to be more of like, we're open for business. So if you make a mistake and it's a legitimate mistake, we're not going to fine you $100 million. We're just going to say, all right, fine. Or if you make a mistake, you know, similar to what you've seen in some of these massive settlements that are sort of very technical, like nothing, you know, very hyper-technical type administrative mistakes, that they're not going to pull down the gauntlet on you, that they're going to try to work with you on getting those corrected. And I think that was the way it was previously to kind of the Warren, right? I mean, that seems to be the they would work more with you. Is that accurate? I mean, I don't know if it's.
Yeah, I think that the punitive nature of rulemaking is a mistake. Nobody likes that except the CFPB, for example. The industry also doesn't like the fact that, I mean, we're still dealing with issues from 6, 8, 10 years ago, if not farther back. Many of those errors have been corrected, but yet the fines and settlements are still going on. So yeah, that fear of enforcement action, that fear of shoot first, ask questions later, guilty until proven innocent, I think that doing away with anything to do with that would be great for borrowers and would be great for the industry.
Now, with that said, right, now I've noticed also some creative loans have got back into the market. So some no credit minimums, some very little documentations, some, hey, send me your bank account statements, and, we'll do a no income verification loan type thing. I've just seen this a little bit, and I'm sure you've seen it as well, kind of carving out the non-QM space a little bit. 1 day out of bankruptcy type loans. Have you seen this? And then what do you think of that?
So I have seen this to some extent. I receive a lot of emails. I'm on a lot of distribution lists. I have seen some programs that I kind of raise my eyebrows at. I've seen, I've heard from loan officers who, and they would say, 10 years ago, 15 years ago, IndyMac or somebody, gee, I can't believe they're buying those loans. I wouldn't loan my own money to that person. Now, once again, that pendulum has swung over to loan officers saying, well, if I had the money, I'd make a loan to that borrower, but yet I can't find an investor for it. So the issue, once again, though, is pendulums swing, and it's hard to stop in the middle. When lenders start pushing guidelines, given non-QM lending, ability to repay in that context, things are going to happen. I'm sure that the lenders have teams of legal staff and compliance personnel making sure they're not breaking the law. Borrowers have always wanted to borrow, and lenders have always wanted to lend. The question is, at what price can they meet? And I think what lenders need to keep in mind, and the good lenders that I'm exposed to, they stay focused on helping their clients in a compliant manner. And if those programs are compliant with current regulations, then so be it. Fannie Mae and Freddie Mac have kind of become the Visa and MasterCharge of the mortgage market. They don't take much credit risk. They kind of provide, the backdrop and the infrastructure for a fee. And that's a very good business model for them. The other companies that have come along, the other investors who have come along, and some of the funds who have invested in mortgages, they're doing it a different way. And if they can do it a different way at a price that borrowers will borrow at and companies will lend at, then so be it. When mortgage capital is scarce, Fannie Mae and Freddie Mac, they don't really add too much substantial new capital to the market. There is this whole talk about private market, the private market out there. When is the private market going to come back? If you want to borrow, you can go borrow. I've never heard of anybody lacking for jumbo loans. If borrowers want a jumbo loan, they can go get a jumbo loan. The question is where they get it. The issue is, independent mortgage banks don't quite have the same knack for doing, and I'm using jumbo loans as an example, but non-QM can be the same, as banks. Depository banks love jumbo loans. They put them on their portfolio. There's no reason to securitize them. It's all well and good, and borrowers continue to get jumbo loans if they want them. Same with non-QM. Some of these banks love non-QM loans. So to the extent that they're putting their own money at stake, to the extent that they have an investor who's willing to take that risk, then you're going to see, new programs. You're going to see these credit score, low credit scores and so forth. But, it's nice to think that buyer beware. you know, it would be good to think that investors are doing a much more thorough job of analyzing the loans than they were 10 or 15 years ago, when companies were just waving the product in and they would do the due diligence down the road. And woe is me, why did I, you know, you sold me this loan, it's not what I thought it was, and I'm going to sue you because of it 10 years down the road. Well, nobody wants that again. So the question is balancing that against wanting to lend money in a compliant manner. So it'll be interesting. I think we could see some more of this as if just Fannie Freddie FHA VA volume dips a little bit, as it is expected to do. So you could see some companies that continue down this path, but I wouldn't say it's going to be a huge revolutionary move. But yeah, getting back to your initial question, yeah, I'm seeing some of this.
Yeah, and from my perspective, what I'm seeing similar to you is there is a place for that niche, and you know, it's not as nearly overly creative as it previously was, but there is they're putting their toe back in the water a little bit with some new programs and some new kind of ways of doing things, and somewhat rightfully so. I mean, there's a level of, you know, if you weren't going Fannie, Freddie, FHA, VA, and didn't meet their requirements right out of the gate, you know, a lot of independent mortgage bankers just wouldn't be able to make a loan, unless you were going jumbo, right? But now, you know, with some of these, you know, the self-employed, the, you know, cash type income people, you know, the idea that there's being programs for them is, to me, is positive as long as it stays within the realms. What do you think about brokers in 2017? So I've seen there's a lot more activity now from what I've seen. It just seems like there's more wholesale activity. It seems like, you know, 3 or 4 years ago, it just seemed like nobody was a broker. Now I'm seeing a lot more kind of brokering activities. And some of it is just program specific. So it's not even that the brokers, they're just pure brokers, but they're, you know, correspondents, or they have warehouse lines and they just broker a percentage of their business to this. What do you think about brokers in 2017? And then the second part of that was what I've seen a little bit is some of the call centers that have had big drop-offs in volume. A lot of those guys are hitting the streets again, trying to go pick up purchase business, and they're going working for brokers. And I've seen that in a variety of areas. That's like a national trend. I've just seen it. What do you think of brokers in 2017?
So the broker model, that's a long way from being extinct. Certain states have seen a decline. When you visit certain states, the broker business is way down. But in other states, not so much. We think the broker was down and out 3 or 4 or 5 years ago, and I think maybe nobody wanted to admit they were actually a loan broker when they really were, and they were saying, oh, we're, mini-core. We're going in the mini-core, we're going to do this and do that, and there were companies, investors offering mini-core programs. The line has blurred between broker and banker. Lenders with warehouse lines, if you would define that as an independent mortgage banker, they will still broker out a piece of their production. The broker, I've never really counted out the broker business. I think that there are advantages, some very good value propositions that brokers offer. The brokers know those value propositions. They come in contact with a variety of lenders, for example. Whereas if you're working for a depository bank, you only have the depository bank's products to offer. So a broker can make the argument that they're saving a borrower a lot of legwork by calling on a lot of banks and so forth. The lenders out there have been very willing, I should say investors, lenders, whatever you want to call them, folks invested in the wholesale channel, they've been very willing to work with brokers. They view brokers as good sources of business and can bring them suitable clients. Brokers can make the argument that they will charge less than other lenders, depository lenders, for example, to originate a loan. So the broker business itself, I think, is alive and well in different parts of the nation. Is it gonna suddenly account for 50% of all the residential lending that's out there? No, it's not. The retail model that's put out there by depository banks and by non-depository mortgage bankers is very strong. But are they going to continue to account for some percentage of the business? Yeah, whether it's 10% or 15% or 20% or 25%. Yeah, somewhere in that range. I don't think it got much below that. I don't think it's ever been much above that. And so when you talk to brokers and they have experience with brokers, a lot of those folks are very smart business people. They have deep roots in the community. The relationships that brokers have with people and in the community is probably much better than it is, or I should say much better than banks have. Banks have taken it on the chin from a public relations perspective in recent years. Brokers not so much. And so if you are if you're a borrower and thinking about getting a loan, they're perfectly happy with working with a reputable broker who has been around for a number of years and has a good clientele and a good referral base, and so forth. So I think brokers are going to do fine.
Yeah, no, and there's a lot. Yeah, some of the, we have some area, companies in our area and some companies I've met with are brokers, and they've been in the business for 30 years, and they have, grassroots, right? They've had the same office, and they own the building, and, they got a good little book of business, and they, do really good community stuff, and then we've got a couple that are like that have been working with us. And in fact, they do a really good value and service to the community. I agree with you 100%. So now that Carson's in HUD, what changes would you like to see? As the next question, is there any changes you would like to see at HUD or through FHA? I know the mortgage insurance premium was one of the things that was pushed and then rolled back. I know there's been talks about changing other things. Is there anything you think should be changed with HUD now that you have a new kind of person at the realm for the next 4 years?
So it gets back to that what I mentioned earlier in the call was the government's role in lending. How much of a role should government take? Should there be any? And Dr. Carson, by all accounts, is a smart fellow. He'll probably lean the way of the Trump administration in general. But it's important for your listeners to frame this discussion and other discussions in the context of what is the government role? What should the access to credit be like? What should the models be like? What should regulatory policy be like? And in all of that is the role of the FHA. So Carson has come out pretty much. It's pretty much viewed that Carson is going to reverse the Obama administration's aggressive enforcement of fair housing laws, including the use of disparate impact. They did roll back the FHA MIP change. That wasn't a huge surprise, but certainly the press has made a big deal out of it in the last 6 days. Every day there's a story about the Trump administration costing homeowners millions of dollars a year. I don't think that's quite fair, but the thinking under Carson is that fair housing is going to take a back seat to reforming the GSEs, Fannie Mae and Freddie Mac, and the mortgage market in general. Not much is known about Dr. Carson's view on housing policy. He did testify. He was approved by the committee. He is expected to receive full Senate approval this week. There could be some pressure brought to bear on him to go along with cutting back the mortgage interest deduction, especially at the higher end of things. That really isn't an FHA issue. But it'll be interesting to see if he tries to reverse HUD's Fair Housing Act guidance regarding some of that, especially like criminal history screening processes. So once again, though, when you talk about the FHA, when you talk about Fannie Mae and Freddie Mac, I think more of the focus may be on Fannie Mae and Freddie Mac. At this point, no one has a strong plan for them. The process has to be worked out through Congress, and once again, it brings up the role of federal government in housing. Should the taxpayer be involved in subsidizing housing? So these are pretty high-level questions that need to be answered,
Yeah.
and I think the current administration will take a different tack on it than the Obama administration was taking. But the thing for listeners to keep in mind, I don't think the Trump administration wants to be known as making it more difficult for borrowers to borrow money. They don't want to be known as anti-housing. And so I think some of the things Dr. Carson does may be pro-housing, but getting back to that pendulum analogy, let's hope it doesn't swing back too far.
Well, and so, I was actually had the pleasure of talking to Dr. Carson last week, and what he was talking about is some sort of rent-to-own type program for FHA. Or some of their sort of, and basically similar to what you said, is just the idea of let's just not make people scared of making loans to FHA borrowers, and then what common sense programs can we put in place to help people own homes and get equity in homes. And then he was talking about some sort of rent-to-own type program, and then he's too smart for me, so I lost the thought. But this is kind of.
How'd you have a chance to meet him?
I'll tell you about that later.
Okay.
I'll tell you. So his. Well, I'll tell you about that later. All right, we'll talk about that later. This is volumes down a little bit across the industry. I think at the independent mortgage bankers meeting, they were talking about, December, everyone just felt like the whole thing was just going in the tank. I mean, we have lenders being down 40, 50, 60%. One lender who I know is down 70%. And you hear about, some lenders laying off whole divisions and, cutting 40% of their staff and things like that. So with that, and kind of the mixed reviews of some of the negative stuff. When do you things are already starting to pick back up? From what I've heard a little bit, January is starting to come back a little bit. What is your thoughts on volume and things picking back up? And I know we're talking about the spring purchase. Some of this is overlapping, but I want to ask this question specifically. When are you hearing volumes picking back up? What are you hearing about volume in December versus volume now? And what are some of your lenders forecasting, or what are you hearing about forecasting for 2017 overall? Are they forecast? I had a lender yesterday that said we did $3.5 billion last year. We're actually forecasting $3.2 billion, a little bit less. And then I've had some that say we're actually increasing, forecasting more. And then, the general consensus one I've seen is they're about 20%, 30% down, but some are 50% down, and some are 10% down. And then I talked to one of our builder clients, and they've had their best year ever, and their December was their biggest month ever in record. So
America is just a great country, isn't it?
I know, right? Diverse, right? Yeah,
exactly.
But just sort of that mix. If you could sum up, just generally, what are you hearing about? Well, what did you hear about December, and then what are you hearing about January, and kind of the forecast? And you're a smart guy, so just not the whole year, but let's say the first quarter, second quarter.
Well, take a step back for a second. I'm not convinced rates are going to go to the moon. Even if they go a little bit higher, doesn't that tell us that there's a demand for capital out there? If the demand for capital has increased due to the economy doing well, getting back to what we were talking about earlier in the discussion, if the economy is doing well, that's good for borrowers. The question is, what are listings like? The nation has been hit with flooding, unseasonably cold weather. I mean, are you going to go out and shop for a house when it's -10 in Minneapolis? Probably not. On top of that, we had the election and rates scooting higher. So the industry in general has gotten hit with a double whammy in December and late November. So that's beyond us. Rates have stabilized, and as you know, borrowers are going to get used to the rates. Gee, okay, they're 4.25% versus 3 3/4. Woe is me. It's an extra $80 a month. But if you're making $160 more because your wages went up, then it's not a big deal. So some lenders out there are nervous. Others are downright excited. Veteran, experienced loan officers have lent plenty of money at higher rates. And I don't think that, psychologically speaking, higher rates don't influence a family's desire to own a home, have a yard, live in a nice neighborhood, put their kids in a good school district. That being said, if there's some company that had a mediocre 2016 or some loan officer who was only doing, a loan a month, what does that tell you about that company or that individual and the fact that 2017 is probably not going to turn that around? So if you look at where the business is going to come from, everyone's talking about, first-time home buyers. First-time home buyers. Everyone's talking about millennials, first-time home buyers, immigrants. You have people coming back into the purchase market because they were foreclosed on, 10 years ago or 8 years ago or whatever the time frame is, and they're coming back to the market. So the demographics for our industry are very good. You've got rents going up, pushing potential borrowers to say, gee, I'm paying $2,000 a month for this studio in San Francisco. I could move to Salt Lake City or Kansas City and pay, principal and interest of $1,100 or $1,200 a month. That's a very compelling argument, especially if you can move for your job. And so when you talk about the industry in 2017 and volumes, it's important, A, to keep in mind that the demographics are favoring us as an industry, B, that interest rates aren't always the only function of whether or not someone's interested in buying a house, and then C, the fact is that, getting back to this demographic shift, we're hearing more and more of that families who can't afford to live along the coast, San Francisco, Seattle, Los Angeles, or Manhattan, Miami, they're moving inland to places like Birmingham or Knoxville or Salt Lake City or Kansas City, Detroit, other places. And that shift, I think, will start to pick up a little bit. And with that in mind, if there are places for sale, I think the market will be very good. So there are some lenders out there who are nervous. Others are excited. Others view this rise in rates as an opportunity to weed out some of the weaker parties. If you're a company, a lender doing 20 or 30 million a month, and you have a warehouse line, you have to pay for a compliance department and have an attorney on retainer and have a capital markets department, et cetera, et cetera, et cetera. It's very expensive to do a loan these days. So will the smaller guys be able to thrive? I don't know. I think there are a lot of smaller guys who are saying, we could be a lot better off if we combine forces with somebody else who has the same departments, same overhead that we do. We could cut our overhead in half, pick up a new geographic area, and do very well. So I think we'll see some consolidation out there. The fact of the matter is, all estimates point to another market north of $1 trillion, and somebody has to do those loans. And lastly, I'll wrap up with, when you talk about the big banks and Wells Fargo and Chase and Bank of America, in terms of market share, when you look at the volumes that Wells Fargo is doing, it doesn't take much of their volume going away and going to the rest of the industry to really make some great years for many other companies in the business. So, it's still a big pie. There's still a lot of entrepreneurial savvy business people out there trying to get a share of that pie. And, I think 2017 will be a decent year.
Got it. No, absolutely. No, I think so too. And then sort of last question. what do you think the next 4 years is going to look like? Do you think that, well, that's kind of an we don't want to get into all that stuff. What do you think about that? This is from one of our listeners. What do you think about the HELOC market? Do you think the home equity line of credit market is going to come back?
I do. If you are a borrower who has a 3.5% 30-year fixed rate loan and you like your house and you like the school district and you and your wife are working in the area and you don't want to refinance and get a whole new first at 4 3/8, you're going to look at a home equity line of credit. You'll look at some kind of secondary financing, which may easily tend to favor banks or companies that offer that product over a company that doesn't offer that product. On top of that, when you talk about products and potential products, the demographics, 10,000 people a day are turning age 62. Brian, you got that? 10,000 people a day. Oh, wow. So you have companies who are saying, what's this reverse mortgage again? Maybe it's not as bad as it's reported to be. Maybe we can do it in a compliant manner. So when you talk about companies looking at HELOCs, when you talk about companies looking at bond programs or down payment assistance programs or things like that, I think, including reverse mortgages, I think companies can do loans in a compliant manner and continue to be profitable if they open their eyes to some of these things like HELOCs. So yeah, I see the market pretty good for that kind of stuff.
Got it. Yeah, got it. And then I know we got to end, but let's see if we can get one more question. Consolidation, merging, home equity line of credit, and that's
so
kind of it.
Let me ask you a question. New appraisers coming into the market. What's the scoop?
That's tough. So that's a toughie. So right now, I mean, a lot of it has to do with just who's going to train them. When you look at the traditional training model, right now the supervisor has to be physically present at all the inspections. And that causes basically most of the supervisors just not having any interest in training somebody. I mean, literally, like if you wanted to become an LO, or if you wanted to become a, if a doctor had to be present every time a nurse, gave a shot. So you right now you have a lot of interest in the idea of new trainees coming into the market. However, the question of who's going to train them, remove the requirements to allow trainees to inspect the property. It used to be that Fannie and Freddie had a requirement that if you were going to have, if you were going to train somebody, that the supervisor had to be physically present. They rolled that back maybe a year or two ago. None of the investors updated their requirements to reflect that rollback, and then most of the lenders and aggregators and all those ones have kept similar requirements in place. FHA has similar requirements in place, and so you run into a situation where there's a market for trainees. Appraisers would love to train trainees, but a lot of it has to do with just the lending requirements of, okay, the supervisor has to be physically present during all the inspections. And with that said, how do you have a situation where, the supervisors are going to be there all the time, and still, be productive, right? If that got changed, you would see a lot of trainees come back into the market. If that one thing got changed. A lot of people blame, oh, well, the AMCs and appraisal management companies are the reason why trainees and supervisors aren't. But there is some attribution to that. But that has really to do with policy. It has to do with lender policy. If you look at, there's some lenders and banks up in the Midwest in Minnesota that allow trainees to supervise, to go out and do it, and they're having huge success in that area in Minnesota with having trainees go out and inspect properties and things like that. So I think personally it needs to come from the lending community, kind of loosening the regulations to allow trainees to inspect the property, and if they did that, you would see everything else come back.
Cool.
So, all right. Well, thank you so much. Absolutely. And thanks, everyone. These slides will be available. We'll upload it to our YouTube channel, and thank you, everyone, for attending. Have a great one.
All right, Brian. Thank you.